Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table. All right, and welcome back to another episode. I'm here today with Grant and Andrew from ICCG. Today we're going to be talking about what is working capital. So we're going to go a little bit into working capital next two episodes. This one we're going to focus on what working capital is and what it looks like in business or in companies. And then the next episode we're going to talk about working capital in action. So to get started, Grant, Andrew, what is working capital?
Yeah, look, if you're wondering why I have a smile on my face, is because we're talking actually what most people think is a bean counter concept, and in reality, it's a management tool, and so I've got a smile on my face because we have this conversation so many times in our office as well as when we're talking to clients, because it's probably the one thing that's deemed sort of almost mystical, but the reality of it is it's such a great tool to use in managing a business. So we'll have fun defining it, but it's going to be different for every single company. But it's basically current assets less current liabilities. So when we're talking about working capital, it's really a net number. It's not it's certainly not just cash. You know, a lot of business owners think it's just cash, but it's cash plus accounts receivable plus inventory, and possibly some other current assets, but then minus your accounts payable or accrued liabilities if you want to get a little more technical. So it is the things that turn into cash or use cash all the time in your business. That's working capital.
And so what is that for? So you talked a little bit about the kind of the equation of working capital. How would you define that? Like what is important about it?
Yeah, you know, if I have cash in the bank, I can spend it, right? I can spend it, but in the meantime, I've got to collect accounts receivable in order to spend money after that, right? And so if I have a very poor month of collections, but I'm carrying on billing my clients, then my accounts receivable is going to go up, but my cash is not. And so, but I still have accounts receivable. People still owe me money. And the question is, have I paid my bills, or are the bills piling up at the same time as well? And so, I think the biggest way I can, or the best way I can explain it is, just recently I read an article that it was by a P group, and they were measuring the ability of a company to convert net income to cash. In other words, over the years and years and years I was a CPA, my clients would say, "What do you mean I made that much money? Where did it go?" You know, because they reinvested the money in the business. And they bought equipment, or they paid off debt, or they did something with it. They distributed it to them, but in a sort of a closed vacuum, you've got net income, let's say, of $1 million, and at least 80 to 90% of that should go into cash, right? Eventually, at least. And so it gives you the ability or the muscle to then go and either distribute the money or invest it in your business. And so it's just the muscle that drives your company forward.
So basically what you need in the company to keep operating. That's awesome.
Would you? I know. We've kind of even said before. We kind of relate it to a car, right? I mean, it's the gas and even the. I mean, it's the quality of the tires. It's just the what gets the vehicle moving, right? Isn't that the way that we've described it before?
Yeah, I mean, if you don't have any gas in the truck, the truck can't run the call or deliver the package. And so you got to have gas in the truck. And so working capital is that gas. It's cash in the bank. It's inventory that you get to sell. It's accounts receivable that you get to collect and spend the money on more purchases or on labor or those kinds of things.
Can you give an example, a simple example of what working capital, a working capital calculation would look like in a business? So you mentioned the inventory, cash, those things. Just kind of add those together, play that formulation through.
Yeah. So before I do, let me just tell you something. In accounting, it's better to be consistently wrong than to be inconsistently right. In other words, if you define the calculation of working capital one way, then keep on doing that one way, right? And the trends in that working capital will matter a lot to your management of your business. So the normal way would be cash plus accounts receivable plus inventory minus accounts payable. And that net number is if you're looking at your financial statements, you look at current assets, it's at the top, and then current liabilities, and you go current assets minus current liabilities. That technically is working capital, but a lot of people don't account for accrued labor or some things that like I said. I mean, if you want to be technically correct, that's great. If you have the accounting personnel to be technically correct, it's current assets less current liabilities. But most people don't, on a monthly basis, they don't, do some of the accruals that are necessary for it to be generally accepted accounting principles.
So before the call, play that out a little bit further. Before the call, you were talking about the difference between a residential plumber and a multifamily plumber, and how that can look different.
Andrew, you'll remember when we dealt with a large plumbing company in the Northwest that dealt with multifamily construction. So they weren't the guy that you called every day to come unplug your drain. These guys actually did all of the construction, the plumbing part of the construction for apartment communities. And so they had a lot of labor. It's more of a construction type company. So the accounts receivable had retainage in there. And so he had to have a lot of working capital in order to sustain his business, in order to keep on paying payroll, keep on buying supplies, those kinds of things. And so you contrast that with your normal unplug my drain kind of plumbing, the sort of the retail kind of plumbing. Well, they don't need much working capital at all. All they need is the amount of gas they need in order to get to where they need to go unplug a drain, because they're going to get paid right away. Right? And then that labor is probably going to be a function of whatever that guy just earned. And so your revenue model doesn't need a whole lot of working capital. You might need some money maybe for repairing the truck every now and again. You might need some money to stock the truck with the supplies that they generally need, with the tools, those kinds of things. But it's not like you are waiting 90 days to get your money. So there's very little need for working capital in a sort of in a scenario where there's not. It's just home service business.
Mm-hmm. Yeah, because you don't want to shut down your business for 90 days while you wait to get paid, right? You got to keep working.
Exactly, for sure.
That's great. So what are some strategies that businesses can use to improve their working capital position?
The one that most people go after first is to collect accounts receivable faster, right? So you change the terms for your customers until you get this large customer that bullies you, right? So I'll give you, I'll give you multi-million-dollar deal, but you're going to have to wait 120 days to get your money. When you're dealing with school districts, for example, we brought that up with a roofing company just not too long ago. You're waiting 120 days to get your money. Well, you got to pay payroll for 120 days before even you got to do the work, and then you got to wait another 120 days. So you paid payroll for, I don't know how long in order to get your money. And so a lot of times you want to balance that with other customers that pay you right when you do the work. And so people, shrink, sometimes they turn business away because they don't want to wait 120 days to get their money. We dealt with a client not too long ago that literally, if you don't agree to 30-day terms, he just won't do your work. And I'd like to be in that position, right? Because everybody wants to be in that kind of powerful position, and because they don't need the work. But most of the time, you're going after collecting money as quickly as possible. You've heard, Michael, I guarantee you've heard in the retail world of sort of this just-in-time inventory concept where you're not buying the inventory until you absolutely have to have it that day, right? And so your inventory is as low as possible. And so people outsource their fulfillment, in order to decrease their inventory to their suppliers, basically. And so we talked about that furniture manufacturer that I used to have as a client who had the foam manufacturer actually manufacture the finished product rather than buying a whole bunch of foam and having to rework the foam internally and have this huge inventory. A lot of people stretch vendors, right? So if I'm only going to get my money in 120 days, then I don't want to pay my vendors before then either. I want to try and stretch my vendors. And so some people can't do that. And so they borrow a line of credit from the bank in order to give them the working capital to pay those expenses while they wait for their money. But those are the kinds of the simple ways that people do to try and make sure that they improve their working capital.
I know a big thing is also where it's all. I know we've kind of talked about how, and this has to do with kind of your machining companies, manufacturing companies. They'll invest in work that does require less payroll, right? And so, for example, like buying robotics, all right? And so it does take less payroll, and so that's going to increase it just because, look, you can stretch out your vendors. You can't really stretch out your payroll, right? You can't do that. And so I've seen people invest in robotics and things like that, the non-heavy payroll work, and some people just can't do that. But that is something that I've seen some people do for sure.
Yeah, that's absolutely correct. I think the other thing is this is why you see, like in the body shop business, for example, there's a push to finish jobs on Friday. It's not just because insurance companies don't want you to keep the rental car over the weekend. That is a big deal. But it's also, I want to finish the job on Friday so I get paid on the same day as my payroll goes out the door. Does that make sense? And so you also get these manufacturing companies and fabricators that know that their clients are going to pay a March 31st invoice before the end of April. So they're pushing to finish the job by March 31st, because if they wait until April 10th to finish the job, they may not get paid until the end of May. Because those huge companies that are buying those products, a lot of times they want to pay bills once or twice a month. So there's every company is different, and every that's why as a small business owner, I remember the pain of having to do the cash flow dance. We meet payroll every week. You've got supplies, you've got accounts receivable. You're kind of managing that on a daily basis, and it's hard. And so as you get more successful, your business owners will sort of accumulate cash and leave it in the company so that they don't have to bother. They just pay all the bills every every couple of weeks, right? And so that you're not getting calls from vendors, you're not, and you really have excess working capital in the company in order to not have the headache of having to manage it every single day, right? So I don't have to hard collect on clients or get all panicked because I've got to meet payroll on Friday if I've got a whole bunch of money in the bank. And that's what we call excess working capital. It's more than you actually need. Does that make sense?
Yeah, I think another one is that I mean, we had a client that would he was in landscaping, right, and he would bill very inconsistently, right, and he would collect it very inconsistently, and so but and I say inconsistently, it was just he just wouldn't bill for a long period of time, right? And so when we looked at the financials, it was always this revenue that was just like 1 month it was a ton, and then one month it just wasn't very much at all, and it was just this up and down thing, and kind of when we were first talking with him, he told us that we don't bill on a consistent basis, we don't collect on a consistent basis, and look, he's done well to where he always has enough working capital to sustain, right, his business, to do payroll, to pay his bills, all of that. But at the end of the day, to build that working capital, it's okay. You can plan, you can be more consistent, and especially with hard collecting, you don't want to get into a position where you are really trying to hard collect your clients, because that can hurt relationships too, right? And so especially when they're recurring, and so that's something that I know is going to be important, just by having a process of that is something that you can do to increase or I guess if you're saying increase working capital, it's really just be consistent,
improve
with,
improve.
There you go.
I think, and this is, we've had a lot of clients that go from being a what we call a small business to sort of a medium-sized business, but they still manage out of the checkbook. If there's a big cash balance, then they're doing great, and they will, make a distribution without really anticipating what their working capital situation is. And this goes back to the whole comment that I made earlier, and that is, it's a great management tool. You've got to, as a business owner, you've got to anticipate what's coming down the pike in a couple of months, because you got, $5 million in the bank, and you go, you know what, I could take $1 million off the table and invest it personally, or invest it in something that I want to do outside of the business, and I might cause a headache for myself in the next couple of months because I'm not able to bill those clients, or I need to purchase, some robotics or whatever it is. You may shoot yourself in the foot. And so thinking ahead of what I'm going to need is a big part of what working capital is. I had a client years ago who was super unsophisticated. He was super smart. And he took this calculation of working capital, and he created what he called the magic number. And every morning on his desk, at that point, it was a pretty large company, nationwide stores and manufacturing. And he, on his desk every single morning, was this magic number, and obviously the parts of it. And he managed the trends of working capital, and that's how he knew what was going to happen cash flow wise in the next couple of months. So much so that if he saw negative trends, he then went to his marketing division and said, "Hey, I need to get rid of some product, and so I need to do super duper deals." He was actually from Colombia, and he used to call them super duper deals. And so he used to discount the product in certain areas of the country in order to raise cash that he needed. He knew he's going to need in the next couple of months for working capital. And so it's a great tool. The calculation is a great tool, but you have to have the accounting systems that are halfway decent in order to monitor, certainly on a daily basis. Most people don't, but at least on a weekly basis. In the businesses that we've run in the past, I've always had that calculation and other metrics, by the way, on a weekly basis. When we were in the body shop business, I wanted to know how many cars were dropped that week, how many cars were delivered that week. I want to know how many not gift cards, how many thank you notes were written. And so as an owner of a business, what you measure gets done. And so when the reason I didn't care to have the number of thank you notes, but I knew that for them to have to put down a number, they were thinking, oh, I need to write thank you notes. And so what you measure gets done. And if somebody's having to report to you what accounts receivable is that week, it's not just the value of having that number and being able to plan with it. It's also telling your employees, hey, I'm keeping an eye on what that balance is. And if it all of a sudden goes extraordinarily high or the aging gets messed up, I know that I'm going to have a cash flow crunch in the next few weeks.
Hey, Grant, earlier you talked about the importance of consistency when calculating working capital, but you also kind of hinted at the fact that there's different ways, there's some variations in the ways to calculate it. So when helping our clients through working capital conversations, how does ICCG calculate working capital that might be unique?
Yeah, in our different businesses over the years, it all depends on the business. And I'll give you an example that's not one of our businesses, but one of the ones that we've sold in the last few years. When we sold a fence company, they didn't necessarily include, all of the posts and nails and things that were work in process in the normal inventory number. And typically that's part of inventory. It's what some other companies call work in process. A lot of our manufacturing companies, their fabrication, they're in the middle of a job, but the job only takes a couple of days. So they don't count it as inventory. And so it's not right, but if you consistently don't count that, then you can measure the trends appropriately. But if all of a sudden 1 week you calculate it and 1 week you don't, it's just not going to give you the right data. And so in some companies, they don't even calculate, they don't even put, any kind of accrued payroll in there because they only do it once a week, like on Fridays, and they've just paid payroll. And in some instances, they don't include it, but they pay payroll twice a month. And some of the commission salesmen, they only get their commission the following month, but they don't accrue that payroll. As long as you just consistently don't do something or you consistently do something, it just helps you measure trends properly rather than all of a sudden the number's different and you go, oh my goodness, what happened? And really nothing happened. You just changed the way you calculated the number.
So Grant, you talked a little bit about the magic number, right? And having that as kind of the key to help you run your business and that you can get in front of that when you kind of know what working capital does for your business. What can happen when you don't do that? What can happen when you don't use working capital well? You don't know what your business needs to run, and you get to a point where you're running low on working capital. How can that look in a business?
Yeah, it's, a lot of times, and this is just, I probably need to apologize on the back end to all my banking friends. But when you need working capital, they're not willing to lend it to you for the most part. And so, just, it becomes too late and you're having to scrap to generate cash in order to cover up the lack of working capital. And so if you can't borrow it, you've got to fire sale products. You've got to give deep discounts, which what that does in the short term. It helps you because you get cash, but in the long term, it really makes you suck. And so, at the end of the day, you want consistency. You want to make sure that ahead of time so that you could have time to mitigate the lower cash flow that you might get based on your current performance. And so any kind of dashboard or indicator, and everybody has them. Every business owner I've ever had, they all know, oh, okay, that's happening. So that means that, next month I'm going to hurt, or next month it's going to be great. I think those are the important indicators. And I would just tell you, if a business owner is not monitoring working capital, they're cheating themselves, because they're losing out on a great indicator of of the trends in their business.
That's great. Well, that's almost it for today's conversation. Before we kind of transition to that next conversation about what it actually looks like in a deal, how it plays out, talk about how a company's working capital position can play into the decision to pursue a sale.
Yeah, I think here recently, we've talked to a company that has, that they believe the company is worth a certain amount. And I agree. I think the company is worth that amount. The problem is that they've taken on a lot of customer deposits or prepaid revenue. And so, that in order for a buyer to pay, I'm just going to use a round number, $100 for that business, then they're going to have those customer deposits to generate the next revenue, the next month's revenue, right? And so, and so it's super important to know what your working capital is and what the nuances are, what the needs are, so that what you're going to get from the sales price. And so it might be that you're one of those guys that I described earlier that has a lot of excess working capital because you just don't want to have to manage cash flow. And so you leave millions of dollars in the bank that you don't really need in the bank. But it's just sort of a safety blanket that kind of covers up the need to manage. And so, you might get more than the purchase price, because if there's excess working capital, then you should get paid for that excess. And we'll get into that in another episode. But I think the most important thing is to know, okay, I'm not going to have to come out of pocket. It's kind of like getting, your $10 million for your business, and then after the fact going, wait a second, I was structured as a C Corp, so I'm only going to end up with $6 million. And you only hear that after the fact. You would be shooting your advisors if that was the case. The idea that you wouldn't know that you'd have to leave $500,000 in the bank account, when you sold your company, would be disastrous, because you were anticipating taking that home. You see what I'm saying? And so it's super important. We talk about the value that advisors bring to the table. I personally think that the value is not in the decision making, because our clients are smart. I mean, they haven't built successful businesses because they're idiots. They are very good at making decisions. What they don't have is understanding of a transaction, and they don't want surprises. And so if you just lay out the facts in front of them, they make great decisions, but they need to know the facts. And when they get a surprise, and how do I deal with it? And then they go, well, I wouldn't have sold my company if I knew I was going to have to come out of pocket, $4 million, And so we just like to minimize the surprises, let them know how working capital is going to impact their transaction possibly, and then manage the negotiation so that it lands exactly where the seller wants.
That's great. Well, that's all the time we have for today. Andrew and Grant, thanks for joining me. Please make sure that you guys join us for our next episode where we will be talking about working capital during a business transaction. And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.